Well, it's nice to be here and nice to see all you guys in the audience. This is a very intimate setting, so we would encourage you to ask questions if they come up. We've got 30 minutes, and so we're going to cover, we're not going to be able to cover everything, so again, if we miss something, do ask the question. In general, we've gotten a chance to get on the phone and talk about various things, but as we got together organized for the panel, there's sort of three major themes that we think we'll cover this morning as I think about our time. One is kind of, are we back to the future with the angel community and the shrinking industry and smaller capital base? Is it sort of like it was in the start of the nascency of the venture capital industry in the 80s and early 90s? Another topic which I think is timely is the consolidation of the industry. How is that impacting your investments and your investment activities? And then finally, kind of what's interesting as it pertains to new deals, new deal structures, the way you think about the business, and those sorts of things. So what I thought I'd do is start with the general overarching question about has the game changed, or are we back to the future? And with that, I thought I'd start with Bruce. Bruce Gibney's with Founders Fund. It's a new organization. This firm started about 6 years ago, I think. He's a new partner, so he's truly next generation in the grand scheme of things, although he'll tell you a little bit about himself and the organization, and maybe a little bit about how the Founders Fund looks at the business today, and are we back to the future?
Sure. So obviously I'm at Founders Fund. I met my partners in school like almost everyone else, and invested my law school tuition in one of my partner's first companies, which turned out to be PayPal. So that worked out, although Mom wasn't super happy about that investment decision at first. I'm not sure that I think we are sort of back to the past in a way in venture, and also in another way in a totally different landscape. And the way in which we're back to the past is that you really do have to invest in long-term assets that have significant technology risk in order to earn an attractive return. And the way in which I think that we're in a different landscape is that the de facto public company rule has basically been eliminated, and there's a large, relatively liquid market for later stage investments, and I think that means that there is a huge opportunity to continue to follow on your investments. So the way in which I think we're sort of right back in the sort of the 60s to 80s sweet spot for venture is that if you're willing to go out and grab an asset that's going to take 5-7 years to come to market, and bear a significant amount of technology risk, I think you'll be well compensated. It's not like the 1990s where sort of, you buy a company that has no technology risk and you flip it as quickly as possible and it explodes. And then you just have to follow these companies on relentlessly. And I think that by the way, explains the sort of much larger fund sizes you see for the successful players in the industry. I think companies are going to remain private for a very long time. And so the example that and I think that's good for our industry, and the example that I would give is sort of like Facebook versus Amazon. So when Amazon went public, the venture capitalists bore 99% of the risk. The market cap on Amazon when it went public was about just under $500 million. Subsequently, sort of gone up to 80 to 100 depending on where we are, and the public markets captured 99% of the return, although they bore very little of the risk. And I think that split is going to be much more favorable for VC on a going forward basis. Companies do not have to go public until very late. With Facebook, which was actually the second deal I worked on with Peter, his $500,000 convertible note that bought 7% of the company in 2004. We bore a substantial amount of the risk, but the private markets have captured a vast proportion of the return, and I think that's self-servingly a good thing.
If it's your money. But we'll talk about limited partners' interests in a minute, because Joan's on the panel and she's a limited partner. But Glenn, in your view, because you all work at Granite Global on not only U.S. companies but also Asian companies, has global investing created some change? That's what's new today?
Thanks, David. So Yeah, I'm Glenn Solomon. My firm GGV Capital, we've been in business 12 years and invest across the U.S. and China, and have been doing so since our inception. And I'd say that is one area I'd like to highlight about what's different today versus when I started in this business close to 16 years ago. Companies in many segments of technology are able to go global much more quickly. We see that across segment. A good example of that would be Facebook. I think, well, they're closing in on a billion users, right? And they can't have more than 300 million by definition in the U.S. So at least 70, maybe 80% of their users are outside the U.S. And that's just incredible for a company that's fairly young. And we're seeing that across businesses that we look at. And so, even versus 6 years ago when I joined GGV, we're seeing the number of CEOs that come to us and say, we want to get to China. We know it's a big market over there. How do we do that? The percentage of companies we talk to for whom that's of interest is skyrocketing. And the same is true of Chinese companies. And I imagine the conversations are very similar for VCs that are active in Brazil and Russia and India and other large markets. And so I think while there's still a lot of truth to the adage about investing in your own backyard and staying very close to home, and the U.S. has obviously been a great place for company formation. We're going to see lots of value that's created outside the U.S. And companies going global much more quickly, companies outside the U.S. coming to the U.S. and attacking markets in the U.S. And so VCs and investors in VC really need to be very cognizant of the global landscape more than they had to at any time in the past.
With both companies and how they manage their money.
Absolutely.
So we've got long-term hold, global businesses being formed. Then we have this whole phenomena in Menlo Park called angel investing, which is wealthy folks from Facebook and Groupon running around doing startups. Somebody said the other day there was something like 15,000 seed projects in the Bay Area alone. Warren, what is that doing to your firm as you think about how the game has changed?
Sure. So Warren Lee, general partner at Canaan Partners. We're an early stage technology venture firm with offices in the U.S., India, and Israel. So I'll explain why that's important. I think one of the trends we've seen is clearly, whereas in 12 years ago when I started in the venture business, you could spend most of your time in Silicon Valley or Boston. Today, you really have to have a much larger footprint and be much more willing to look across the country as well as internationally for the best investment opportunities. We've tried, at least for the angel investing side, it creates complications for us because suddenly you have a massively increased number of opportunities to look at. So there's just a basic issue about how do you due diligence these companies, how do you filter out the many companies that are getting started, how do you get access to these companies. What we've tried to do is certainly work with all the incubators and angel investors that are out there. At the end of the day, I think relative to 12 years ago, the quality and the sophistication of some of the really early seed stage opportunities that come on our radar screen is actually much higher. So we actually end up seeing, generally speaking, a higher level quality of deal flow. And I think that's great for us because at the end of the day, most of these companies still need to raise substantial funding afterwards, after initial seed stage investment. And we're in a good position to be able to take advantage of that.
But are they also creating a competitive atmosphere for your early stage investments with all of those individuals? Because I think that to me that's the capital piece of this is what's really kind of creates noise. And
I think
how does that impact your?
I think it depends on sector. I think certainly some sectors like consumer internet, where it doesn't take a lot of money to get off the ground, you can actually, with a relatively small seeds investment, give a company a lot of runway to build the business. I would say for other sectors like enterprise software, semiconductors, some hardware plays, you still need some of the more institutional, traditional venture firms to come in and play that role.
Okay. So Joan Hytem works with Spur, which is a venture capital fund of funds. The rest of the guys are general partners investing in companies. So we have Bruce that wants to hold companies for 20 years and really get a lot of the private accretion because of the secondary market that's available to them and some other things?
10.
Okay. I can do 10.
Well, 10's hard too. Anyway, I'm embellishing on your comment. We have guys that are domestic all of a sudden going overseas, and we have this huge angel phenomena that is causing a lot of noise at the very, very early end of the market. How does that impact what you're thinking of as you look at venture as an LP, and how do you invest from a portfolio perspective? As far as what do you bifurcate any of that? Do you worry about it? Are you happy? Are you sad?
Yes, no, all of the above. No, so I'm Joan Hydorn. I'm a managing director at Sport Capital. We're a fund of funds, and we focus exclusively on early stage venture capital. As far as David's questions, if I can remember them all in
There's
order.
12, yeah. Sorry.
We do pay close attention, obviously, to the amount of money going into the industry, the mix of general partners, where they're investing, what they're investing in. My observations, having done this for a very long time, are that we think a contracting industry is healthy to a point, but now we're at a point where we have, I think what I read was almost 60% of the capital being raised by the top 20 firms. And that's okay, but what it poses for us as a limited partner is even more emphasis on a transparent relationship, on being sure that people are staying focused on what they're doing, because that's a tremendous weight of capital in a small number of hands. But on the other hand, if you look at the fact that I think Peter Fenton said yesterday that the top 5 funds, and there's at least 20 top 5 funds, I'm sure, earned 60% of the returns last year. So it is important to be in the right sectors. As far as how we think about it, and one of my partners is Paul Gompers at the Harvard Business School, so we tend to take a little bit of an academic view of this and sort of balance that against reality. But we do believe the finding that there's a persistence of return in venture. So when we think about structuring our funds, we think about who are the general partners that have proven a track record, or in the case of newer funds, what do these people bring to the table that gives us the sense that they're people that have persistent returns? We're less concerned at this point, not concerned, but we don't say, we want so much in Asia, so much in India, so much in China. We pick managers, but we do have a bias towards investing in the U.S. because to this point, that's been where the bulk of the returns have been. Did I answer all your questions, David?
So let's touch on something that's jumped up that I think is important to this topic of the next generation. So the industry in 2000 had roughly 2,000 active venture capitalists walking around with checkbooks making deals. Today, according to statistics last year, something like 167 firms did more than 4 investments in a 12 calendar month period. So we've gone from 2,000 down to sort of 10% active firms doing investing. I think that number is probably a little bit discounted. I think we're probably somewhere around 300 or 400 firms kind of active. I would say on a global basis, that's certainly the number. But so that landscape's changed, which is my notion of back to the future. So how is it impacting your deal making? I'll start with Bruce.
Well, it's nice to have compression in the industry because the absence of competition is always attractive. But the truth is there just aren't that many good deals, and relative to the number of persistent general partners, there's still a substantial number of general partners for every good deal that's available. On the angel side of things, they've definitely pushed up valuations in consumer internet, which has been problematic. And also, I think there's something of a distraction. I realize it's like self-serving and somewhat controversial. But
Well, I think it is too. That's why I kept bringing up noise as the word. But go ahead.
Yeah, I think they're actually somewhat problematic for companies. They set valuation expectations that are not sort of entirely reality-based, and I think they're actually something of a distraction. And they also sort of induce people. So I mean, the real growth in the investor relationship has of course not been obviously in the traditional GPs, which have contracted the traditional venture funds, but the expansion of angel investors. And I think there's something logically incoherent about the angel proposition if it's not attached to a much larger checkbook. You know, the first angel proposition is sort of, you know, that, by the way, everyone's a super angel, is that, you know, they're going to help you in some way as a company. And if you just look at the size of their portfolios, and some of them have these sort of dozens or even hundreds of deals, I mean, this is mathematically, there's no way they can spend any time with you. And so I think that's a distraction for the companies. They can't follow on, which means the companies have to be back in a fundraising cycle. I think that's a distraction for the companies. And they honestly, you know, again, they put valuation pressure on some of the lighter weight, on a CapEx basis, the lighter weight deals. And that's problematic for sort of the traditional general partners, which are going to have to follow on. So I think the contraction in the number of general partners, which just as a pure mathematical matter, is like if you just look at the Cambridge numbers, most general partners are actually pretty bad. That's a good thing. But the expansion in non-traditional general partners has been, I think, a bad thing for the industry overall, both on a returns basis and on their effect on companies. So, again, I realize it's not entirely polite for me to say that, but I think it's true.
Right. So from your view, being a newer firm with plenty of capital, you guys are pretty happy to see the industry decline in size and scope, and I guess I would say I would be if I were you. So less competition and more interesting projects, right?
Yeah, I think it's just a rational member of society. You know, if 80% of an industry just misallocates capital on a sort of like multi-decade basis, then, you know, it should contract. So I think that we've wasted too much capital as a society on crappy deals.
Got it. So Warren, you're in the healthcare business in addition to doing technology investing. With this consolidation, how are you dealing with, how's your healthcare portfolio dealing with that? How are you guys as partners dealing with that? Because that, if there's part of the pie that's really consolidated, it's healthcare.
Sure. So Canaan, we do about 1/3 of our investments in healthcare and 2/3 in IT. And you know, I think the last decade, certainly, healthcare returns have been very positive, at least for Canaan. I think what you've seen recently, certainly in the last 18 to 24 months, is an attrition on the healthcare pure play company firms that are out there. There have been a number of firms who have announced they're not going to raise more money or they're going to scale back their activities, which I think makes sense given some of the hurdles or regulatory hurdles that you're starting to see from the FDA and some of the capital intensity around these deals. What that has done, I think, for kind of the top tier firms in healthcare is that if you're still a healthcare startup and you're looking for access to capital, there's fewer firms to go to. And I would say that, and I don't do healthcare, I'm on the IT side, but my healthcare colleagues are incredibly overworked right now. I think that they are seeing probably the best deal flow that they've seen in a long time, and that's just because there's fewer firms for healthcare entrepreneurs to go after. I think the way I look at healthcare is it looks very much like a semiconductor deal in terms of its capital intensity and its science and, you know, development. So when you're doing a healthcare investment, you're really looking at trying as best as you can predict the amount of capital that's required to scale a business and bring a product to market and through the trials, and then making sure that you have the right investor syndicate around the table to be able to fund the company. You know, ideally you'd like to bring in new investors as the company or the product evolves, but in some cases, if the market's not behaving or there's some other external shock to the system, you need to make sure that you have a syndicate around the company to really carry the company through.
Right. I would think syndicate risk is probably the biggest thing you've got to deal with in your portfolio with the shrinking of the capital base.
I think that's actually for both healthcare and IT. I think one of the things we've, you know, like after the boom bust period, the dot-com bust, you know, we sat around and looked at what we could have done better during that period of time. And one of the things I think we've realized that we didn't spend enough time looking at our co-investors and making sure that there was cohesiveness around the investor syndicate for all of our companies. And we ran into some situations where certain members of the syndicate couldn't support the company. That obviously would be a negative surprise to the startup. So I think we've become much more diligent about how we reserve capital for follow-on investments, but also the co-investors that we try to attract to a particular company.
Right. So China, which is where Granite Global traffics, had an enormous fundraising year in 2011, first half for the most part. So now you have a lot of competition. How is that impacting how you're managing your business and your investment activity? Because the flip side of that is the market itself actually went the other way, and so it seems to me that China's trying to figure out what it wants to be as far as an investment environment.
So when you think about environment and whether or not venture returns will be good or not in any one particular period, I think it's important to look at what's going on the funding side, but equally important, if not more important, is to look at what's going on in the company landscape. And I can say that go back to something I remember John Doerr spoke about in a business school class I was in the early 90s. He said that, technology waves, every new technology paradigm shift creates disruptors who eclipse the companies in the prior generation and create more value. And when I look at, I think there's a lot of wisdom to that. And, right now, all of us get the chance to invest in companies in IT. They're taking advantage of what I think is the biggest paradigm shift we'll see in our lifetimes in technology, which is the infusion of mobile computing. And that's the reason why social has become so valuable and why there's so much opportunity in local and why things are going global so fast, in my opinion. So I think that just creates a great opportunity for us, period. And then you look at, okay, huge opportunity, lots of great companies being created. I would take a slightly different view than Bruce. I think there are lots of great companies, not just a few. I think the evidence supports that conclusion. And so then you've got, okay, how much capital is there out there to go after this great opportunity? And I think right now is a very interesting time because, as you point out, David, at least in the U.S., there's less capital and less active firms than there have been. In China, I would say, interestingly, although there's been a lot of money raised, some of it's in RMB funds. And we actually, as a firm, can look, across those two markets and see where the deals look more attractive. And over the past year, we've seen better opportunity in China because, as you talked about the public market in China and the opportunity for Chinese companies to come public in the U.S., sort of all depressed at once, and people saw that very quickly and reacted. And so there was the doom and gloom there presents opportunities for us to invest at better prices, whereas here in the U.S., in a certain segment, there's still a lot of froth in the market. And so I think you kind of have to look at both the underlying opportunity and the capital and its availability to make the assessment of whether or not it's a good time.
Got it. Well, according to my clock over here, up on top of we've got 3.5 minutes. Are there any questions from the audience? We have a mic.
Hello, Marcel Lubben, DSM. I'm a corporate venture, and I did the whole subject of globalization came up several times. I was wondering, and that's actually a question to all of you, but maybe Glenn, you wanna take it because you've been very active in China. So what does it take for you to be globally successful as opposed to being more nationally successful?
Well, I can speak to that most closely with respect to China. And I can tell you in China, very, very challenging to be a flyover VC, to be someone who sits in Silicon Valley or the New York market and kind of flies into China, spends a week, looks at deals, picks one, comes back, and then flies over once a quarter for a board meeting. And I suspect that's the case in other markets as well. I think the way we're staffed, we've got, our investment team, we actually have more people on the ground in China than we do in the U.S. My partners we're about half-half. And so we're extremely local in the way we pursue deals, but we then try to staff every deal with particularly those companies where we know there's a cross-border element to the deal with partners on both sides of in both nations. And that helps be both local and at the same time think global. It's not an easy model. I've got 27 trips to China over the last 6 years to prove it. It's taxing, but I think that's, at least what we found, the best way to pursue that strategy.
Question here in the corner.
Hi, Adam Caper, Synchrony Venture Management. So there's been a great resurgence of corporates in the last 8 quarters or so, and I didn't hear it mentioned in terms of the future landscape. It seems that non-commodity money that comes with partnerships and sort of tangible value add, like purchase orders, seems to really be in the marketplace right now. And I'm wondering how that affects your thinking about your portfolio companies and how the capital landscape may evolve over the next couple of years.
Why don't we get that to Warren?
So prior to joining Ken, I was at Comcast's venture group, so I'm familiar with the corporate strategy or / investment area. I think
We have 30 seconds.
like traditional venture firms, there's an assortment of corporate firms. Some are good, some are bad. There's a whole spectrum. And I think when it works right, you can actually get some significant strategic value and purchase orders. But again, that's not always guaranteed. So I think you just have to be very careful about who you're partnering up with and whether there's really a good alignment between the company and the strategic investor that you're thinking about bringing into the company.
That was part of our Back to the Future theme, that couldn't get it all in 30 minutes, so thanks for asking. I think with that, we're going to wrap things up. I want to thank the panel for their contribution and the audience for their participation. So thank you, everybody.